Let's turn to the topic of risk management. This study session is a little bit different because the focus is on the investment business. So when we're talking about management in this setting, we're primarily talking about the risk. What if you ever become the executive director responsible for an investment bank or a large division within an investment bank? How do you control the risk of the business? Now, obviously, a lot of that will be investment related because of the nature of the things you do are investment related, but there are also business issues that have to be considered. So they're shifting the perspective. You see this happen a number of times at level 3. Often we're talking about portfolio management, but at other times we shift to the issue of business management. And that's where we're going to focus. This first module is mainly introductory terminology. You have taken CFA exams. You know the emphasis is not questions that are definitional. To the extent they're definitional questions, it's application of concepts. So memorizing definitions by itself is of little value, but you do want to have a general familiarity with terminology. So let's move through this fairly quickly. We've got a couple of lists. They're those kind of lists. Nobody can argue with this. It's the CFA list. What do we mean by risk management? We don't mean minimize risk. We mean understand the risks that exist and decide where it's appropriate to take or not take a risk. You're trying to make money. You're trying to be profitable. Taking no risk is not going to work. A no-risk position should earn the risk-free rate of return. You can't operate a business on that principle. So their approach is identify, measure the various risk exposures, set the levels of risk, not minimize, set the levels that are risks that are appropriate. Where are you good at something? Take risks there. Where are you not good at something? Don't take risks there. Basic principle. Report those to the various parts of the organization that need to understand it, monitor what's happening, and where things are out of place, adjust them, hedge, adjust the portfolio, do whatever is necessary to place the exposures at the desired tolerable levels. When we talk about risk governance, policies and procedures that are going to implement the above. Now, there's a choice, centralized or decentralized. Let me give you an idea. Let's suppose that you, at some point in your future career, probably towards the end of it, you are responsible, you are the chief executive officer of a large investment bank. Within the investment bank are key operating units. Each one has a head. Do you want to have each operating unit monitor and control the risk in that unit? Of course, they're going to do those things. Are you going to let them do it unit by unit and just tell you what's happening? You're just going to trust whatever they tell you. That would be a disaster. They may be very ethical, but it's just inherently risky to put the people in charge also in charge of monitoring and reporting everything they do. That would be a decentralized approach. The more sensible approach is centralized. You have another separate unit which is responsible for monitoring each of the divisions, determining the risk, reporting to you what the situation. You have an independent reporting process. So make sure as you go through this reading, you conclude the centralized process is much more appropriate. And of course, centralization also means specialization. You're going to have experts in risk management that understand the issues, because we're going to see this is not necessarily a simple process. You can build up the infrastructure to do this. You can determine who reports to who. We want to go with the more centralized approach. What methods are used to measure and quantify the various kinds of risk in the organization. Those are all the elements in risk governance. Enterprise-wide risk management, ERM, would be the name for centralized system. Identify the risk, quantify the exposures, estimate the overall risk to the organization, which is going to imply dealing with correlation. We can't just add up all the risk exposures. One may offset another. Another reason it needs to be a centralized process to see the big picture. Set up the procedures for reporting, make sure people comply with this. And you see the term VAR. We will be looking at VAR in more detail as we go through this segment, or later parts of this segment. Financial risk is often going to be a major part in investment-related businesses, and you see a list of 6 kinds of financial risk. As a trick question, they also segment financial risk between what they're calling market and non-market financial risk. The first 4 items, those are priced items. You can look at interest rates, you can monitor it, you can monitor changes in exchange rate, equity prices, commodity prices. Those fluctuating prices and levels create risk, but they're relatively easy to monitor. Credit risk, liquidity risk, those are certainly tied to financial assets and liabilities. But historically, it is more difficult to quantify and measure credit risk and liquidity risk. So they're considered financial, but they're not called market risk. They're not as easily to readily look up and price. They are going to point out that statement to some degree is changing. It's becoming easier to quantify liquidity and credit risk. There are kinds of derivatives that can be used now to monitor, to modify some of those exposures. Derivatives can be priced. So there is changing occurring, but they are distinguishing the market versus the non-market types of financial risk. Credit risk. A counterparty doesn't make their payment obligations. That's the definition used here. Now, I've got to caution you. We use the term credit risk regularly, and that's an awfully narrow designation. More generally, credit risk, changes in financial quality that increase or decrease the likelihood of being paid. That is a more typical general definition of credit risk. I would certainly go with that. I'm just pointing out in this particular reading, the author got a little bit nitpicky about it. And as they say, credit derivatives now exist. So it's requiring some of the characteristics of a marketable and measurable risk. Liquidity risks. Can I get in or out without significant price concessions? That is definitely a more difficult thing to estimate or measure. We don't have a ready way to price and observe the levels of liquidity risk. So these involve a little bit more subjectivity than monitoring the price of a currency contract or of a bond or of a stock or of a commodity, where it's easy to use the market to observe what's happening. That's the distinction they're making. However, in a business organization, even if it's an investment business, that's not the extent of your risk. You have other kinds of risk, and here we have a list of other kinds of non-financial risks. These are also critically important, and certainly companies have gone bankrupt by not paying attention to the non-financial risk as well. So they can, in some cases, be every bit or more important. Let's kind of talk about each of these. This is just, alternative to the underlying. What do we mean by operational? We have an operations department that keeps track of everything. People make inputs. People make mistakes. Somebody fails to put in and input an order correctly. Or it was a buy order for 10,000 shares and they put it in as 100,000 shares. That's going to have consequences. That was an operational mistake, human error, things that go wrong. Again, like liquidity, it's not that hard to measure and quantify it, but you certainly have to consider it. If you follow the financial industry, you certainly are aware of situations where mistakes occurred that became serious multi-million-dollar issues for organizations. We hope that's the exception, but it does happen. Model risk. When we have non-marketable securities, we have to estimate what their value is. You've studied a lot of that at level 2. You've seen the some of the models used in estimating the value of derivative positions. Those models require input. Sometimes there's more than one model. Mistakes can occur. Might have used the wrong model, might have put the wrong inputs in. Those would be model risk. In swaps, there's counterparty risk. Anytime you have an overcount of the derivative, you could have counterparty risk. The other party doesn't do what they said they would do. This is also called Herstat risk, named for a bank where this happened some number of years ago. This bank was party to a number of swaps. So on a swap, you're paying out and you're receiving in. So let's say, you're a very responsible, credit-worthy individual or institution, and on your swaps, you're making your wires out of what you owe on the swap, and you're expecting to receive back. But it turns out your counterparty is getting ready to declare bankruptcy. They're in trouble. They're happily accepting the wires coming in, but they're not sending anything back out. They're just grabbing everything they can get and not wiring back. Well, that's clearly going to create problems. It can create a chain reaction of defaults within the industry. Now, as a result, we came up with netting. We don't wire and wait to receive. We calculate what should go out, we calculate what should come in, and we determine whatever the small differential is. It's got to be small because it's one versus the other. Which way is it supposed to go? And only the small differential could move. In addition, you're going to find out that even over-the-counter derivatives are setting up central clearinghouse-like operations and using them. So the distinction between over-the-counter and exchange trading is starting to blur. It's starting to become less distinct because of problems that have occurred over the last 10 years or so. So settlement risk, failing to, we wire out, but we don't receive back in. Regulatory risk, rules can change. You may be doing everything correctly, and next year you got a problem because they changed the rules, and suddenly applying the new rules, we've got some problems. This is not looking good. It's causing situations. To the extent you use cutting-edge strategies, cutting-edge securities or derivatives that are new, the chances of changes in rules and treatment are increases. Things can happen. You've done everything right. You've had the best advice. That is not a guarantee things can't change, and sometimes they change not in your favor. Legal, contracts, legal systems, the rules can change, but many legal systems are subject to interpretation, arguments, litigation. You believe in your position. So does the other side. Ultimately, the judge will rule. May go in your favor, may not. The more complex the things you get yourself into, the greater the risks that go with these types of situations. You have to be aware of that. You have to take that into account when you're running a business. Tax risk, again, rules can change. You may think you were prepared, suddenly the rules are different. Accounting rules change. May change in your favor, may not. So all of these are part of the risk management process. Ultimately, we want to aggregate all of them together. Sovereign risk. If you do business with a sovereign government, yes, you've got to consider, are they going to be able to pay you? Is the financial ability to do there? But you have another consideration. Do they want to pay you? Are they willing to pay you the money, even if they have it? Because if they don't, if it's another company, you have well understood approaches to take. You have recourse to legal systems to try to enforce your contract. And if it's a pretty straightforward contract, it is pretty clear cut. They're going to lose. They're in the wrong. But a sovereign government decides they don't want to pay. They're clearly in the wrong, and they don't want to pay. What are you going to do? Sue them. You got to sue them in their court system. You may or may not get a fair play. What if the court rules in your favor and they still say no? How do you take the money back? Who is going to enforce the rules against a sovereign government? In the end, there's always a go to war, but that's not very practical. Political risk. Politics change. Parties change power. That's also another consideration to deal with that's going to have to be considered. Environmental, social, governmental, a new buzzword, ESG, referring to the nature of our societies are changing. What's important is changing. The importance of environment, it was going up in the United States, maybe it's going down. It shifts around. The more you use with new securities and derivatives, the greater these risks. Yes, consult qualified advice. That still doesn't guarantee things can't go wrong. So ultimately, you need to put all this together. Another particular kind of risk that's popped up a few times, what's called performance netting risk, performance-based fees. Maybe they don't offset each other the way intended. Best illustration is this example. We've got a firm, and they charge a performance fee. They also use 2 sub-managers, and the sub-managers also have incentive fees. So the firm expects to earn an incentive fee. They employ sub-managers who are doing some of the management, and the firm also pays an incentive fee to them. Well, this should be okay. If the sub-managers do really well, we owe them a fee. We'll have done really well at the firm. We'll get an incentive fee. Everything will be fine. But check the fine print. The firm receives an incentive fee based on total performance. But the way it was written in this case, they pay a fee to each sub-manager separately. So A outperforms. We got to pay money to A. B doesn't outperform. We don't have to pay to them. Now, when we aggregate the 2 together, our total performance, we didn't outperform, so we don't earn anything, but we owe something to A. That was a problem. Somebody should have thought about this before they set all these arrangements up. And you see I put a note in. Normally, when you have performance fees, general presumption is they are asymmetric. Outperformance earns an incentive fee, but underperformance doesn't mean you have to pay anything back. So that's why A outperformed, we owe, B didn't outperform, we don't get anything back, but at the total level, we're not earning anything. We've got a cash flow problem in this situation. So we've largely run through some basic terminology. Please don't spend too long on it. You want to move on into application. Do notice in terms of a centralized versus decentralized, clearly you want to come out in favor of enterprise risk management, the centralized approach for its benefits.